Canada's new trade agreements with countries such as Germany, Japan, and South Korea focus on diversifying its energy exports, thereby reducing dependence on the U.S. market. This strategic shift significantly reshapes energy dynamics. This potential transformation in Canada's energy exports could lead to soaring fuel prices in the United States, impacting various sectors including automotive and manufacturing. Consequently, consumers may experience immediate financial repercussions. In its pursuit to become a global leader in electric vehicle production, Canada is investing in domestic manufacturing and mineral refining. This strategic change stands to disrupt the supply chains of U.S. automakers significantly. The U.S. tariffs imposed on Canadian materials, intended to strengthen American industries, have inadvertently backfired, prompting Canada to seek economic independence and explore new trade partnerships. With a robust $300 billion investment strategy, Canada aims to modernize its transportation and energy infrastructure, further reinforcing its economic independence while reducing reliance on U.S. supply chains. Through significant investments in pipeline expansions, port upgrades, and railway enhancements, Canada is positioning itself as a direct supplier to global markets, which diminishes U.S. influence in the sector. The expansion of Canadian ports, particularly in Vancouver and Prince Rupert, strategically positions Canada as a key player in global trade, operating independently of U.S. shipping routes. Canada is making substantial investments in renewable energy sources like wind and solar power, with the goal of becoming a leader in clean energy and attracting international investments. With significant investments in electric vehicle battery production, Canada is emerging as a dominant figure in the EV supply chain, which could disrupt U.S. automotive manufacturing dramatically. Canada's new trade agreements with European, Asian, and emerging markets enhance its economic independence, reducing reliance on the U.S. This move could reshape the landscape of North American trade. The U.S. automotive industry heavily relies on Canadian resources for production, and any disruptions could trigger a significant supply chain crisis, emphasizing the interconnectedness of both economies. Rising costs of raw materials and supply chain disruptions are pushing American automakers to seek alternative suppliers, affecting production costs and vehicle prices. This shift may further burden consumers in affording new vehicles. China's strategic expansion within the EV supply chain underscores its dominance over global mineral reserves, potentially threatening American automakers' access to affordable materials. This can lead to substantial market shifts. Canada's ability to attract major battery gigafactories and investments from global automakers signifies a pivotal shift in automotive production power, redefining Canada's role in the global auto industry. As uncertainties in the supply chain continue, consumers grapple with whether to purchase now or wait for better deals, complicating their decision-making process amidst an evolving market landscape. Canadian agricultural products, including fresh fruits, vegetables, and canola oil, play a crucial role in the U.S. market. Any trade restrictions could lead to increased prices for these essential items. The retail sector will also feel the effects of rising tariffs on Canadian goods, impacting a wide range of products from lumber to clothing, resulting in higher prices and potentially reduced availability for consumers. The construction industry relies heavily on Canadian softwood lumber. Disruptions in trade could lead to rising housing costs, significantly impacting both builders and homeowners.